Greetings and welcome to our next module, or next segment of Module 4. This is our third segment so far. We're going to take a look at disaggregating the ROA into two segments, profitability and productivity. If you recall, we had the DuPont method, which took the financial leverage and our return on assets. That was disaggregation of return on equity. Well, we're going to disaggregate return on assets now. We're going to go a little deeper dive into one of the segments. And the two segments where we can multiply them together, the same way we did on the DuPont method, are profitability, the profit margin, and productivity, which is measured by the asset turnover. So taking a look, here's our ROA, net income over average total assets. We know about that. We separate now into our profit or net income percentage, net income as a percent of sales, bottom line divided by net sales. And we have the sales over average total assets. So our asset turnover, based on what we invested, how much sales have we generated? We have sales in the numerator and average total assets in the denominator. So we define those both, so it increased the profit margin, we increase profitability for a given level of assets, and increase the asset turnover, reduce assets while still generating the same profit level. That's how we both affect return on assets. So you're going to want to memorize, yes, these ratios. You're going to want to have them on call. They're going to make sense to you. And there's a logic here. The net income percentage or profit margin is pretty logical. The sales over average total assets, asset turnover, how much of our assets are responsible for the sales that we generate. That's probably going to be a little bit more to internalize, but I have full confidence in your capability of accomplishing that. So again, this is the bottom line picture of when we had the DuPont method. Return on equity, net income over average assets, the ROA, times the financial leverage of average total assets over average shareholder equity. Now we're going to be getting into some more ratios here. Okay, so we're separating, and this chart actually brings out a little bit bigger picture of how we're separating things out. So we have return on equity with the financial leverage on the far right, total liabilities to equity. And then we have times interest earned, one of those measurements that basically, how are we able to pay the interest obligation? There's a ratio associated that we'll see the formula in a little while. On the ROA side, we have profitability. We have a gross profit margin, and we have an operating expense margin, and a bottom line net income or net profit margin. So you say, wait a minute, what's my profit margin? Yeah, you do need to say it depends and answer the question, is it the gross profit, revenue less cost of goods sold, or is it the net profit, revenue less all the stuff, expenses to go with that? And we'll talk about operating profit and non-operating profit a little bit later. And then we have a productivity measurement. And there are a number of ratios that we talk about. And we will, not in the next segment, but the segment after that, we're going to be talking the formulas with these ratios. And you're going to get to do lots of calculation and analysis to understand these. So we got receivables turnover. What is receivables turnover? Well, receivables, how fast do we close out our receivables? Or bottom line, how fast do we get paid? And we can measure that in number of days on average. And that's going to be a calculation, one of the ratios. Same thing for inventory turnover. Typically, it's much better to have faster receivable turnover, get paid faster. Inventory turnover, get your inventory out the door faster. Then we have accounts payable turnover. How fast do we pay off our payables? And to conserve cash flow, you might want to do that a little more slowly if you can. There's a cash conversion cycle, which we'll talk momentarily, and property, plant, and equipment turnover, PPE turnover. So these are all ratios that we will be discussing. If you recall the first slide, we talk about ratio analysis. We also talk about horizontal or trend analysis and common size or vertical analysis. So those are going to be the three analyses we use on these financial statements. And here we're going to be, again, the steeper dive to go with profitability analysis we're going for. So gross profit margin, influenced by the selling price of a product and the cost to make or buy those products. So that's the cost of goods sold, cost of sales, cost of products sold. That's deducted from sales to get to our gross profit. So that's the gross profit margin. Generally, higher is better. lower or decreasing margins, possibly more competition or less demand. So if oil prices are rising, and that's what our costs are, and our sales don't rise, we get squeezed. If we can raise our selling price and not affect others, we actually get the additional margin to go with that. Low or decreasing gross profit margins signal more competition or less demand than the company's products. So that's basically increased competition. You can't raise a price. If it's really competitive, maybe you have to lower your price or discount. And if the costs don't change, you're now making less gross profit, which ultimately will yield less net profit, net income. Sometimes products costs have increased. We're going through a lot of inflation. And when you go through inflation, naturally your costs increase. Can you pass those on? Sometimes yes, sometimes no. Maybe the product mix has changed. Maybe you have multiple products. They have different levels of gross profit and margins to go with that. And depending how the mix is affected, you can be more or less profitable as a gross profit. Or volume has declined and fixed costs have not. So you might have a fixed cost associated to maintain. We'll see more of that when we get to the managerial accounting, which is the second half of this course. So here we go, operating expense margin. General operating costs for each sales dollar. So we have our SG&A, selling, general, and administrative expenses. So how does that relate? What's our margin, our percentage related for operating expenses as a percentage of sales? By the way, on the income statement, everything is measured to net sales. We'll talk about vertical analysis in the balance sheet where everything's related to total assets. What's our inventory percentage, our receivables percentage? What's our fixed asset percentage as a percent of total assets? But here we're talking about gross profit as a percentage of net sales, net income as a percentage of net sales. In this case, operating expenses as a percentage of net sales. And over time against peers, making sure peers, you can see actually a decline of the expenses associated. Operating expense margin has been declining. And so less expenses to go with that. So now we're looking at the productivity side. We talked a little bit about some of those ratios. We'll talk a little bit more. We have asset turnover, sales over average total assets. So how fast are we turning over this income statement item over a balance sheet item? So the income statement item is in the numerator and average of the balance sheet item. We've seen that before. That might not be a bad way to remember it, is that you're taking the average. If you're doing a asset turnover, where the assets go, it's a balance sheet item. Oh, we got to take that average. That's going in the denominator. Sales is going in the numerator. Okay. But then we have three other turnover ratios. We have receivable turn. Again, we have our income statement item in the numerator and the balance sheet in the denominator. So income statement, receivable turnover is based on sales at retail. The sales are at our selling price. Our accounts receivable is at our selling price. Our cost of goods sold, on the other hand, is at our cost, and inventory is on the books at our cost. So inventory turnover uses the cost of goods sold on the income statement over the average inventory, that balance sheet item. And then we have our accounts payable turnover. Again, based on our costs, what we're paying, our payables are at the cost that we incur, not at our selling price. So our cost of goods sold is also going to be in that AP turnover, where the average accounts payable is on the bottom. So why are we pulling all three of these together? Why are we looking at all three? Well, we have something called the cash conversion cycle. What's the stuff? We get it, sell it, and convert it into cash and pay for the stuff that we owe. We have to combine all three of these items. So we're going to add our days sales outstanding, DSO, from receivables, to our days inventory outstanding, our DIO, and subtract. You can't just add all three together. We're going to subtract the days payable outstanding, DPO. Okay, a bunch of TLAs, a bunch of three-letter acronyms there. But they actually should make sense because we're buying stuff. And if you notice the description here, cash conversion cycle, average number of days to buy inventory on credit. That's the payable side. Sell the inventories on credit, accounts receivable, and then collect the receivables and ultimately pay the accounts payable. So we're taking the payables, the inventory, the receivables, and taking all of those into account when we're calculating these ratios. So which would you prefer? Would you want a higher conversion cycle or a lower conversion cycle? Basically, operating cycle, it's the cycle to do business. Would you like to make your money faster or slower? Most of you probably are thinking faster is usually better. And I would agree with that. It usually is. But you sometimes can't control that. Sometimes your vendors dictate policies on payables, on you will pay as you see, as you want, and you will be paid as your customer sees fit. So if you want to do business with GM and they say, we're going to pay you 100 terms, 180 days net. Say, wait a minute. I need to collect within 30 days or 60 days. I need my cash flow. I got to finance GM. Is that fair? Well, GM it's as fair as GM wants it to be. They'll say, nope, that's our policy. We have 6 months, we pay you. At Best Buy, why do you think they can give you 2 years, no interest financing, or 3 years, no payments, no interest, no financing? Because Sony gives Best Buy 3 years terms. They can pay in 3 years if they want, and they can pass that on to you because they're trying to get rid of TVs. Payment terms are price is one thing, terms is another thing. It's all gets negotiated in the process. So we're looking at these ratios, these analyses, and making these calculations to determine what is our cash conversion cycle. So let's take a look at some of these conversion cycles by industry. So utilities, pretty short. Make the energy, you consume it, get paid for it every month. Healthcare, there's some longer term here. We got to do some major tests and we get the bills going, and insurance companies take their sweet time sometimes to pay it, and individuals may not be paying it or are paying it or are on a payment plan to pay it. IT is number 2 on this list. Consumer staples, that's fairly quick. Consumer discretionary, fairly quick. Okay, so we're looking at the variations on the cash conversion cycle. A single number is meaningless, but if you compare the number to others in your industry, if you have 6 hospitals together, they can compare numbers. You know, 5 utilities together, they can compare numbers. That's when you start taking advantage of those analyses, again, in comparison. You can compare yourself to last year or the previous year. Are you improving on the ratios? Faster receivables turnover. Let's look at Apple's conversion cycle. Apple is actually, you wonder why they have so much cash. This is going to help explain that. They have megabucks on their balance sheet in cash. So they have days sales outstanding, days inventory outstanding, pretty quick turnaround, days payable outstanding, they kind of stretch that one out for a negative cash conversion cycle. You mean you can have a negative cash conversion cycle? Short answer is yes. Apple doesn't carry a lot of inventory. Products are pre-sold. Good business to be in. Quick sales and relatively long time to pay suppliers. We'll pay you when we get around to it. 73.6 is the bottom line cash conversion cycle. They can invest the cash it receives using somebody else's money before they have to pay their suppliers. So they get this cushion sitting on their balance sheet that they put in other investments. Maybe they buy their own Apple stock, or they buy other stock or other marketable securities, or invest in other activities. And they generate profit from the sale and from investing the cash. Isn't that cool? Isn't that a nice thing to do? So a negative cash conversion cycle is positive. Good thing. Let's look at Merck. Merck Sharp and Dome, big pharma, pharmaceutical company. DSO. Now we're comparing years. Remember we said you can compare to others in the industry? Okay, so we can look at Pfizer versus Merck. But we can also look at Merck versus Merck versus Merck for 3 consecutive years. So if we look at this, our days sales outstanding went from 62 up to 63 down to 61. That means we're collecting our receivables on average every 61 days. Let me ask you a question. Is lower always better? Well, don't you want to get your money faster? Probably. Let's think about that. Let's say, okay, C-store, convenience stores. You sell to C-stores and you're a candy maker or a candy wholesaler. And you say, you know what? My terms are net 30. And you say, here's my candy bar, $1 candy bar, which is going up to $1.25 now, costs 75 cents. You pay me and I will sell you candy bars pay me in 30 days and we're good to go. If someone else says, well, I'll pay a little bit more, instead of 75 cents, I'll pay 80 cents. Because the problem is I might have my cycle to sell candy bars is not 30 days. My cycle might be, I don't know, to sell candy bars, it may take me longer. Okay. So, or say I'm at 20 days and originally I was financing it. Another company comes in and says, you know what, I'll do you one better. My terms are net 15. I'll do business with you, but I'm going to charge you more. And you say, okay, I can do that. And now you're saying, interesting. Am I going to be able to compete on a net 15 terms when my cycle, I'm not able to pay my vendor in that if I have a 30-day term? So you might lose sales by trying to tighten up too much. So you're going through and saying, I'm in a situation where I have receivable turnover, I have faster turns, I'm collecting faster, I'm going to change my terms to 15 days. Okay, that's cool. I'm going to collect faster. But the company's at 20 days to sell your stuff. They're going to have to be financing when it was final was net 30. So if somebody else says, I'll give you 45 days, I'll give you a month and a half to pay me, I'm just going to be charging you more. And you'll say, well, that's going to be a slower receivable turnover. That's going to be more days receivable. But the advantage of that is I make the money in the time. Okay. So at 20 days, that's my sale. I'm fine. When I was at net 30 with you, that's great. You cut me down to net 15. I can't pay you everything because I gotta pick up the difference because I've got a 20 or 25-day sales cycle. I've got another vendor who's going to charge me a little more, but it's worth it. It's all about the cash flow. So when we're looking at cash flow, those are decisions that companies make. So faster is not always better. Faster turnaround, quicker collection, because now I just lost sales. If I cut my net 30 terms, net 15, and somebody else is willing to do net 40, I will lose that business. So food for thought and direction where we're going. All right. So cash conversion cycle. We were looking, actually, let's go back here. So we were just looking at DSO, days sales outstanding. We have days inventory outstanding and days payable outstanding. So our days inventory outstanding is, we really jumped from 16 to 17, not necessarily a good trend, but we pulled it back in 2018. We're watching the numbers. And then our payables outstanding is actually improving. It's a little bit longer, close to 90 days. Wow. From originally 72 days. So in overall, down to 116, our cash conversion cycle is lower to go with that. So it's quicker turnaround. And then we look at 17 to 18, the change to go with that. And that's more effective, more balanced, more where we want it to be. Improvements. Again, improvements are relative. So, and then we have a sales or cost of goods per day calculation. Sales on DSO, cost of goods on inventory and payables per day. And we have a cash savings. Basically, we got a bigger cash cushion that we're gaining that we can reinvest or do other things with, and not using somebody else's money, using our money. So trends are favorable. The question is, too favorable? That's an interesting question to ask. Beware the short-term improvement at the expense of long-term market position. So if we go back, and we'll see this in our last grouping, if you go back and say, well, my inventory turnover ratio, let's go back up there for a minute. I want to go inventory turnover. If I go in and say my inventory turns are faster and the inventory turnover ratio is calculated by having inventory turns of cost of goods sold divided by average inventory. If I cut my inventory down to next to nothing, my turns go up like crazy because the denominator is being reduced. But what happens if my inventory goes to a smaller number? I've got less to sell, and maybe it adversely affects my sales out the door. So people don't see that much. That I don't have these products on the shelf. If I don't have milk to sell, you're not going to buy milk and you're going to go to another store. I might be wonderfully managing my inventory, but that's not what's going to help make the business, because I need to have enough inventory to make my sales. Property, plant, and equipment, same idea. PPE turnover. Sales, new income statement item over average PPE, property, plant, and equipment. Divesting of unproductive assets. We got stuff, we got equipment that we don't use, or buildings that are not used. We got to get rid of them. There are joint ventures. There's sale and leaseback opportunities. That's usually for taxes or for owners that are trying to, they might own they might want to cash out of the business and take a lease back on the property, and there's sale leaseback opportunities, and somebody else takes over the business. So we've got the big analysis of profitability and productivity showing here. And finally, financial leverage benefits stockholders because you're using somebody else's money. There's a liability equity ratio here. And then the times interest earned, which we'll go into more detail, and we'll have some homework on that. Earnings before interest and taxes, so net income before interest and taxes, divided by your gross interest expense. So if I have more earnings, that's a higher ratio. I'm better able to pay my interest expense. If that number reduces, I might be a little tighter, and I may not be covering interest expense as well. And that's what times interest earned means. So that's the nature of what we have. That's where we're at. I thank you for your time and look forward to the next video with you. Talk to you soon.